Hey, good morning. Let's go over today's trade plan. So in the overnight session, ES failed at the 18 to 20 resistance zone, which was a really important inflection point in the market. And on the downside, a failure at 18 to 20 would bring the 2000 to 2003 area into play. So that was from the notes for the overnight session from yesterday's recap. So we ended up getting a pretty decent pullback overnight here. But at this point, heading into the open, we're going to be using 96 quarter to 98 quarter as the micro bull bear zone, and a break above 2003 would confirm a failed breakdown in the overnight session around that 2000 support, and that would bring the 07 to 08 resistance zone into play, and 11 to 13 half. And 11 to 13 half is then an area where we could still see some responsive selling on first test, but really the major resistance on the upside is at 18 to 20. That was the main inflection point from yesterday as well. So if we really start rejecting the lows here, especially if we break above 03, then eventually the market can still make its way back up towards 18 to 20. But we do have these hurdles along the way. 07 to 08 is the short-term resistance above 03, and then 11 to 13 half is the main resistance area on the day time frame. If ES fails at 11 to 13 half, then we can still balance and head lower, and then a breakout above 11 to 13 half would bring the 2015 and 18 to 20 zone into play, and at that point that would still be an important inflection point. And if we break out above 18 to 20, then of course the overall bias would be supporting the buyers, and we could get a run up to 26 half. So that's the upside scenario in the event that the market holds 96 quarter, 98 quarter, and breaks above 03. Both of those things have to happen in order for the upside scenario to really come into play. If we continue failing and we just hold below 03, then it would still be a pretty weak market. On the downside, a break below 96 quarter, 98 quarter would confirm the sell side in control and bring the 90 to 92 initial support zone into play. But at that point, we have to keep in mind that we are trading below the micro bull bear, so the sellers would be in firm control. So 90 to 92, it's a valid support zone. It's a short-term inflection point, but it's not a zone that has to cap the downside, right? So that's something that we'll have to gauge in real time, see kind of how the market approaches it, how the underlying internals look at that point, whether there's still any broad market strength or weakness, if things are really at extreme. So that's something we'll have to gauge in real time. But 90 to 92 would be a short-term downside target if the market fails to hold here at 96 quarter to 98 quarter. And then below 90 to 92, we have support at 85 half, and then 81 half to 83 half is still a important inflection point. But we just have to keep in mind that going down there yet again would mean that the zone is weaker than it was yesterday, right? So yesterday we had key support at 81 to 83, which marks the bottom of a bigger picture balance area, and we saw that we got a pretty big reaction off of that zone. Today on the day time frame, 81 half to 83 half can still result in rotation, and it can still provide a reaction, but the more times you test a zone, the weaker it is, and the more prone it is to give way and actually break. And below 81 half, the market would then easily be able to tag the 76 half level and potentially even lower. So that's something we'll have to again gauge in real time. Just keep an eye on what type of volume the market is seeing in real time. If the relative volume is quite high and internals are extremely weak, then we don't have to hold 81 half to 83 half. Then we could just go lower and tag some of those even lower support zones. So at this point, we know that the overnight session, the sell side has been dominant, and holding below here at 96 quarter, 98 quarter, 2003 is just a confirmation that the sellers are very active here, and that could still result in some more downside to come. So that's really the view heading into the open. Let's keep an eye on the micro bull bear 2003. That'll give us a good idea of just how dominant the sell side is. If the market starts trading above the micro bull bear and above 2003, then we'll have to adjust our bias and we'll understand that the market can move higher, at least up to 11 to 13.5 from there. So these are the primary zones that are going to be in focus heading into the open here. Aside from that, we have a couple of econ reports out this morning, Chicago PMI, consumer sentiment. So just be aware of that around the 8:45 a.m. and 9 a.m. Central Time. And lastly, just keep in mind that it is the last day of the week, and typically the best setups are going to be in the morning. And as we go into the afternoon session, usually the setups are not going to be quite as good. So on that side, it's certainly worthwhile to be a little bit more aggressive in the morning session and then start being a bit more conservative as the day goes on and we start heading near the close, heading into the weekend. So those are the main thoughts. Again, let's see how the market reacts at the micro bull bears. So far, we are seeing some pretty aggressive selling, but how the market reacts at the micro bull bear and at the 2003 resistance is really going to set the tone essentially for the day. So these are really the key spots heading into the open. So those are our main ideas. Let's see how we react here, and we'll take it from there.